The biggest winners in the U.S. stock market right now are not tech stocks. They are not AI companies. They are U.S. banks. In just a short time, bank stocks have added hundreds of billions of dollars in value. And most people don't fully understand why. So the real question is this a once-in-a-decade opportunity or a dangerous trap for investors? In this video, I'll break it all down, clearly, simply, and honestly. What is actually happening? Right now, major U.S. banks like JPMorgan Chase, Bank of America, Goldman Sachs, and Wells Fargo are outperforming many parts of the market. Money is flowing out of speculative sectors and into financial stocks. This shift didn't happen randomly. It happened because the environment for banks is changing fast. To understand why this matters, we need to understand how banks really make money. How banks make money. Banks don't work like tech companies. They make money mainly from three things. First, interest rates. Banks borrow money cheaply and lend it at higher rates. Second, fees and services. Credit cards, mortgages, business loans, wealth management. Third, economic activity. When people borrow, spend, and invest, banks benefit. So when interest rates stay higher for longer and the economy remains stable, banks become extremely profitable. Why deregulation matters? One of the biggest reasons behind this rally is deregulation expectations. Over the last decade, U.S. banks faced strict rules, higher capital requirements, stress tests, limits on risk-taking. Now, investors believe that regulatory pressure may ease. That means banks can lend more, keep more profits, return more money to shareholders through dividends and buybacks. For Wall Street, this is a green light. Why big money is moving into banks? Institutional investors, hedge funds, pension funds, large asset managers are rotating their money. Why? Because tech stocks are expensive. AI stocks are crowded trades. Banks, on the other hand, look cheaper, generate steady cash, benefit directly from higher rates. When big money moves first, retail investors usually notice later. Why this is different from 2008. Many people hear bank stocks and immediately think of the 2008 crisis. But today's banks are very different. They hold more capital, face stronger oversight, are less exposed to risky subprime lending. This doesn't mean banks are risk-free, but it does mean they are more resilient than before. The risks most people ignore? Now let's talk about the risks, because no investment is perfect. First risk, economic slowdown. If the economy weakens, loan defaults increase. Second risk, interest rate cuts. If rates fall too fast, bank profits can shrink. Third risk, political uncertainty. Regulation can always return if policies change. Smart investors don't ignore risks, they manage them. What this means for average investors: if you're a long-term investor, banks can offer stability, dividends, lower volatility than growth stocks. But chasing hype after a big rally is dangerous. The key is understanding why you're investing, not copying headlines. What to watch next? If you're tracking U.S. bank stocks, watch these things closely. Federal Reserve signals, inflation trends, loan growth data, credit defaults. These factors will decide whether this rally continues or pauses. U.S. banks are powerful again, but power always comes with responsibility and risk. The opportunity is real, but blind optimism is dangerous. If you want to understand the market, not just react to it, make sure you stay informed. Thanks for watching.